Most major bank economists, except for Kiwi Bank, are expecting a 2.25% official cash rate, and that's it. But in my view, I don't think they're free enough to speculate and to say what they really think will happen. And that's unfortunate because interest rates are one of the primary drivers of not only the economy, but of our wealth. It's not the way it should be, arguably speaking, but it is the way it is. So, before we get started, if you don't know who I am, my name is Darcy Ungaro. I'm a qualified financial advisor and I've lived in New Zealand since 1985. I've done a degree in applied economics in the mid 90s. I started practicing as an advisor and then I started investing myself. And when that happened, I really began to learn. And what I've learned about how to build wealth, I think has actually changed now to the point where I now recognize that the model still taught in most universities, and certainly the model that's practiced within most central banks, is not fit for purpose to handle the world that we're about to get. But in this one, I'm going to take you through the two main reasons, and they really are very simple, but the two main reasons why I think a significantly lower official cash rate is not just a probability, but an inevitability. Hope you enjoy. Let's get started. Now, before we get on to the two main reasons why I feel a much lower OCR and therefore much lower mortgage rates are coming next year, I want to discuss different groups of people and different paradigms, different ways that you can approach this, because I believe they're all valid, but they're just not fully complete. Now, the first group of people might be property owners, or they might be people who have businesses that profit off of rising property sentiment. There's a huge industry pushing property in New Zealand, and they have a vested interest, right? Of course, there's a slight conflict of interest, but I think more or less it's kind of obvious that the reason why they're putting content out there and being optimistic about property is because they're pumping their bags. And even property owners like myself, we feel good when our net worth is increasing. So I think it's important just to put it out there that sometimes our personal bias will filter through how we view the world and what we think is right and just. But let's not forget that there is a lot of cash still sitting on the sidelines here in New Zealand. And there are a lot of people that kind of understand how the game works. Rates go down, property goes up. And if the rates are going down and all my money is sitting in a savings account, well, I'm not making much, am I? So I'm going to put it back into property. Now, the next group of people, well, they recognize that the economic and financial system is often unjust and it creates inequality in that it favors those who own shares and property, often at the expense of everyone else. Like if people are free to buy as many properties as they want, then if that pushes values up, if that pushes prices up, then people that are struggling just to save a deposit, well, you're just pushing that thing further and further away out of reach. And if people don't have skin in the game in our society, then that can actually lead to poorer outcomes. Then there's the group that are concerned that the inflation dragon hasn't yet been slayed. We don't want lower interest rates yet because we haven't yet seen the impact of the previous rate drops. And I guess it makes sense, right? If inflation picks up again from here and we end up needing to have higher interest rates in the future when we're barely struggling to crawl out of a recession right now, well, what's that going to do? It's probably going to tip us into a depression. We or they are all missing something really important. It's the main thing, too, that this isn't about what should happen in the world or in our economy. It's about what will happen. When we look to the future, it's increasingly difficult to remove our own ideological biases. But let's wind the clock back just a little bit so that we can understand what central banks were doing. Because the first reason why I think that interest rates are heading much lower is that central banks were already struggling well before the pandemic hit. There was a lack of cash in the right parts of the financial system, and they were also struggling with inflation. I know that sounds odd because they're struggling with inflation right now, but how they were struggling with inflation back then was a little bit different. We often expect that central banks only act to reduce inflation. And according to the Reserve Bank of New Zealand Act, they are mandated to keep inflation between 1 and 3% over the medium term, not 0%, not 1%, but 1 and 3%. They actively work to not only reduce inflation when it gets too high, but more often than not, they're acting to make sure inflation increases because the natural state of any economy which is infused with technology, is that goods and services can become cheaper over time. That's deflationary. So, in order to make sure that the system always has between 1 to 3% inflation in it, they have to act to ensure that there is more currency constantly being injected into our economy, even if that means finding ways for government to borrow without adding productivity and finding households to borrow without actually adding productivity either. So, 2019, September 17th, we had the US repo crisis, and overnight lending rates between US banks spiked from just under 2.5% to over 10% overnight. It's kind of like when you drain a little bit of your oil out of your car. It'll still work, but eventually the friction builds up and you get a seizure or it breaks down. Another way to look at it is that if there's not enough money in your main bank account to pay a big bill coming up, you're going to drain some of your other accounts in order to make it work. You might even hit the credit card, and that's when interest rates really spike. And in a nutshell, that's kind of like what happened with this repo crisis in September of 2019. The US Federal Reserve had to step in and inject over $75 billion of liquidity, cash, to make sure that the system could continue to function properly. The issue is that it demonstrates that a system that requires constant fine tuning also demonstrates that it's not exactly robust. They had to figure out a way to get more money, not just in that part of the system, but in all parts of the system. Now, let's keep going. Before the emergency cuts of March 16th, 2020 actually kicked in, the official cash rate in New Zealand was already at 1%. The federal funds rate was at a similar level. Why was the official cash rate so low before March of 2020? I'm going to suggest that they were trying to fight a battle that started all the way back in 2008. The Reserve Bank of New Zealand, like other central banks in the world, they were struggling to get it up. They wanted to build in a little bit of resilience, a little bit of a buffer. Fortunately for the Reserve Bank, unfortunate for the entire country, we had the Christchurch 2011 earthquakes. And that devastating event, I guess, in a sense, created the necessity, or you could say the cover, to justify reducing the interest rates aggressively. Sitting up here in Auckland with my massive mortgage, why should I benefit from lower interest rates when those who were suffering the trauma of an earthquake were actually the ones in genuine need of help? Now, central banks may not orchestrate these financial crises themselves. Having said that, do check out this video where I had a conversation with the author of The Creature from Jekyll Island if you want more background on this one. But while they might not be the official puppet master, they have honed their ability to respond in a coordinated manner when a crisis appears. And this expertise, I think, is due in part to the Bank of International Settlements, the BIS, which has played a really key role back during the pandemic and even today with the rollout of central bank issued digital currencies, or the attempted rollout of CBDCs. So if central banks were already struggling to get inflation up, but lowering interest rates continuously since the GFC wasn't working, what does that suggest about where things are at today in the New Zealand economy? We're sitting at 2.5% in the official cash rate, and we were sitting at 1% in the official cash rate before all the drama began. 1.5% away from current settings. Is the New Zealand economy better, worse, or the same as it was back then? I know, inflation, right? Inflation. Well, we had a problem with inflation back then too, and they were trying to get it up. Now they're trying to get it down. Let's not forget AI-induced productivity enhancement that will no doubt have a factor. Technology makes everything cheaper. Maybe central banks know this. It's not something that we can be too dogmatic on. So when we think about the different points of views and the different groups of people who have different motivations and different biases, I believe they're all right, but they are missing one thing, in that central banks will act to protect the system despite the negative spillover effects that it has on society and our economy. Now, the second reason that a lower official cash rate is coming is that it is a systemic inevitability. The more of something there is, the lower the price will be, and the more demand there is for something, the higher the price may get. And when we have stable prices, we have the perfect balance between the forces of supply, the ability for the economy to produce a good, and the forces of demand, the ability for consumers to consume a good. So you can't just constantly increase supply and expect that the demand will be constant. So on the other side, we really have to look at the forces of demand and what drives that. We have net migration, which has to be one of the biggest factors, partly due to falling birth rates and maturing workforces. We're bringing people in from overseas to goose our economy rather than encourage reproduction at home, right? It's short sighted politics, in my view, and it's not a stable way to grow a society, a country, a population. It's like having a sail, right? If you're constantly enticing people to come to your country rather than work at the core fundamentals of what it means to be a New Zealander and why it's good to invest, to own property, and to grow a family here who is also invested in this country, if we constantly rely on a shortcut, then we're also exposing ourselves to the risk that a better deal comes along right across the Tasman to entice those same people elsewhere. It's a very short sighted and disastrous strategy, in my view. But it's one of the factors that will boost demand for housing. Another force of demand is economic growth and productivity. New Zealand will only ever be able to grow so much. We really only have a hope in increasing our productivity and doing more with little. And we often look to the government to save us here and to somehow magic up productivity. It's like as if it's their problem. Um, in my view, they just really need to get out of the way, if nothing else. And we ourselves, and remember, I am a Kiwi, so I can say we here, we ourselves need to ask some really hard questions like, why are we or why am I unproductive? Maybe I'm too inward focused. Maybe I don't celebrate success enough. Maybe I'm too envious of other people, or maybe I don't take enough risks. These are more, I guess, these are more hardwired mental things that are holding a lot of New Zealanders back. And unless we solve those issues, we're probably not going to be more economically productive. The problem is in our head, not in our hands. Lastly, though, we have interest rates. In my view, interest rates are the primary driver for demand. And therefore, when you're trying to understand where house prices are going, this is the one thing that you look at. Our economy is so unproductive that we've become a host to a central bank parasite who engineers credit creation through the conduit of housing. I know that's a mouthful, but that's exactly what is going on. And as the cost of money becomes so low that it's almost the same cost to own a home as it is to rent a property, people logically will choose to buy property and some will keep on buying more. And as a result, this will push prices up. More people competing for relatively finite supply push prices up. And this will force everyone to borrow more if they want to buy housing as well. In the end, higher prices across the country lead to larger mortgages, which means that there's more credit, which is sloshing around the economy. When there's more money chasing a relatively finite supply of goods and services and assets, prices go up. And that's exactly what happened following March of 2020. But considering the median income doesn't rise as fast as median house prices, the only way to ensure that people buy housing or keep buying housing is to keep reducing interest rates. And this is why, with each cycle in the housing market, we often will see interest rates hit lower lows and lower highs. While never explicitly stated, the government and central banks actually want house price inflation because this means that more money is moving through the economy, which, yes, ultimately ends up in a larger tax take. In a perfect world, the extra money would come through businesses creating and doing stuff and doing it better over time, and ideally by selling stuff to the rest of the world to bring more money in. But instead, we have reality. We have a Ponzi scheme through the housing market, which can never stop. Now, remember, it's not about what should happen, it's about what will happen. And I guess at this stage, you might be wondering how long this can go on for and what happens from here. Do interest rates just keep going to zero and then go negative? I don't know, to be honest. I'm still curious about that myself. In fact, in 2018, that was exactly the topic that I was quite obsessed about was what happens when we get negative interest rates. I do think we can kick the can further down the road, though. And I think we will see lower interest rates, higher house prices, and we'll go through another cycle. Central banks will overcorrect and we'll just keep going. There are two choices you have here. You can either be a victim and complain about what's happening and hope for a government of the left or of the right to save us, or you can choose to take advantage of it for yourself, for your family, for those that are important to you, right? Now, without getting too political, I certainly would be very careful of voting for any politician who promises to give you what you want, because in the process, you might lose everything that you need. But for property owners, your mortgage is likely your biggest expense, and it's highly probable that that mortgage will get a lot cheaper. What are you going to do with that money? If you are younger and you're still building up, then repaying your mortgage, that's a really conservative strategy. Instead, maybe you should be thinking about putting that money towards more investment activity. Grow first so you can harvest later. If you're older, maybe you take the interest rate savings and you convert it into more aggressive principal reductions so that you can absolutely reach your debt free goal before you hit retirement. For those that are looking to buy, whether you're a first home buyer, you're an upgrader, or even an investor, the OCR will hit between 1 to 1.5% by this time next year, and that is a no money guarantee. 1 year mortgage rates, by the way, will be just over 3% or just under 3% if this is true. Now, I'm putting this out there. You do what you want with this, do your own research, and make sure that you've got your own brain switched on, thinking critically before you take action on anything that I've discussed in this one. That's it for this one. I hope you enjoyed, and we'll catch you in the next one.